starting with China, which is pledging support for its economy and giving a big tailwind to the nation's main indices. Tech shares and property stocks both jumping as leaders used a crucial Politburo meeting to flag more aid. They vowed to, quote, elevate stable employment to a strategic goal. That follows disappointing economic data. So what effect is that going to have on those Chinese stocks, and how should U.S. investors be thinking about this? Gabriela Santos, J.P. Morgan Asset Management Global Market Strategist, is still with us. We're seeing, for example, some of the U.S.-traded China companies that are getting a boost. But, you know, we've talked to some other investors who just aren't that interested in China right now. They don't think that the stimulus is going to be effective. How are you thinking about it?
So I think China is, as always, there's a lot of noise around China. I think it's one of the most important ones to really sift through that noise and figure out the signal, but especially now around the conversation of the recovery. I think it's really important to recognize two things about China's recovery right now. Number one, it's the first time in its history that it's a recovery driven by consumption. Household consumption after 3 years of stop-start, zero COVID policy. So we haven't seen this before. And naturally, it's something that takes longer. It takes longer to get confidence to build, takes longer to get households to spend than a recovery fueled by infrastructure and exports and manufacturing. And the second thing to note is that these days, China's focused not just on the quantity of its growing at all costs, but the quality of it. So it's trying this balancing act of managing long-term priorities with short-term priorities, so structural and cyclical. And I think that's why investors had gotten a bit too enthusiastic about a very, very quick recovery out of China. And now some of those hopes have been a bit disappointed with the April, the May, and the June data. That doesn't mean it won't happen. And that's why we now feel like sentiment is too negative on China. It swung the other way about its recovery, about its earnings prospects, and hence about return potential in its markets. And I think it could be a surprise, a positive surprise for the second half of the year and into next year. Depressed valuations, 10% below average, depressed sentiment, and an eventual return of confidence, of household spending, and hence of earnings. And the Politburo meeting yesterday was a really important step in that direction. A lot of the conversation was around boosting confidence, especially for the private sector and households. And what would really help would be a little bit more stabilization in housing and housing prices.
In the near term, the data has been pretty ugly. So China has slowed down. Those GDP figures, not so great. Europe, I think this week, those PMIs, pretty ugly. Yet this comes as the Dow's eyeing potentially 12 straight days of gains. Should U.S. investors care what's happening in overseas economies right now?
Absolutely. And I think for China specifically, it's the second largest economy, second largest markets, most importantly, in the world. Outside of China, there's a lot of good stuff happening in other emerging markets. Competing with the NASDAQ comes Taiwan and Korea related to a turn in the semiconductor cycle. Comes Latin America, an expectation of rate cuts, fueling flows and fueling a rebound in earnings. So there's good stuff, too, happening when it comes to emerging markets. When it comes to Europe and Japan, we are the most excited in a decade about these markets.
About both of them?
About both of them. Because it's beyond the cyclical, what's happening with second quarter, third quarter GDP. There have been two huge structural changes in these markets. End of deflation and end of negative interest rates. It's huge. Combined with the end of fiscal austerity in Europe. It means you can actually get some okay growth and good earnings growth for banks, for industrials, for commodities. The second big change is both of these companies took a look at what the U.S. does and realized that returning capital to shareholders is a good thing, and it's something that's rewarded in stock prices. So we now have the same buyback yield in Europe and Japan as the U.S. So that's a huge just corporate governance change. So two big changes, and I think you just need a catalyst to get these, to get Europe specifically going again. But there's very powerful structural trends. And Japan has already been benefiting from that.
Yeah, it seems like Japan's further along in that process. When is that growth going to be coming for Europe? And what are the contenders for that catalyst?
So I don't think we should, get too carried away about growth in Europe and the actual GDP growth. We're talking about an economy growing about 1.75% in the long run. But it's more the kind of earnings growth you can get in these companies now versus the last decade, and the discount that's still being applied to them as if nothing had changed. And that's specifically around European banks, European industrial companies. It's a very different, much more positive environment for them in terms of their earnings growth, and the discount that's persisted for a decade it just no longer makes sense. The other thing about Europe is there's a lot of growthy stuff in there too, related to growthy themes, whether it's luxury goods around the Asian middle class, whether it's the energy transition, which Europe is very much a leader in, or whether it's related to semiconductors. So you can get both. You can get value, you can get growth, all at a discount.
Interesting stuff. Thanks so much, Gabriela. It's
Thank you so much for having me.
Thanks for coming in. Gabriela Santos
Thank you.
is JP Morgan Asset Management Global Market Strategist. Thanks again.